So I'm Steve.
I'm Riley.
Tax Force is our company. What's the segment called? The segment's called Teaching Riley.
So when you start a business, maybe you're a sole proprietor, maybe you have a partner, there's obviously different business structures, but at some point you might be thinking about getting incorporated, right? So I want to know why you would want to do that. Like, what's the benefit of getting incorporated, or when should you start thinking about that? Maybe one reason why people would want to be incorporated.
I think that's a great idea, Riley, to cover one benefit, because talking about getting incorporated is a big subject that we can take a lot of time on. Most people want to get incorporated for one of two reasons. What we hear most often. One is either for legal liability, or most often, because we're an accounting firm, we hear that people want to pay less tax, and they hear that the corporate tax rate is lower. And so I want to get incorporated because I hear corporations pay less tax. And that's like knowing a little bit of a big story.
Yeah.
Right? It is true that corporations are taxed at a lower rate than the average tax rate that individuals pay in Canada, but there's a bunch of what ifs that are tied to that. One of the big benefits of becoming incorporated, or one of the times when you would look at getting incorporated, is if your company is looking at a big expansion that includes taking on a lot of debt. The reason for that is because it does tie into the low tax rate that you pay. All right? So we're going to give a little example here written down so that you can see it. But essentially, let's assume that you've got a business that you're in the 50% tax rate.
Okay.
Okay? So every dollar that you make, every net of expenses, the government's going to take 50% of that. Right?
Love that.
Love that, right? Okay. In a corporation, the corporation's going to be taxed at a lower rate. In Ontario right now, it's about 12%.
So a much lower rate.
A much lower rate, right?
Okay.
How does this work into debt? Okay. When you're paying debt back, every payment that you make has some interest and some principal.
Right.
Right? That's how the balance of the loan goes down. For taxation purposes, when you're paying down a loan, while you don't have the money anymore, it's not an expense. It doesn't lower your taxable income. Right? Because it's considered to be a transfer of assets.
Yeah.
I had money in the bank. Now I owe the bank a little less, but I've got this asset that's paid for, or a little more paid for. So if you've got a loan that, let's say your payments are $1,000 a month,
Okay.
right? So now you've got $12,000 in 12 months that you pay. And let's say that half of that is principal.
Okay.
So at the end of the year, you owe what? $6,000.
$6,000.
Right.
Yeah.
Less on this asset. Well, if you did that personally at a 50% tax rate, how much tax are they taking? $3,000, right? So even though you don't have that $3,000, you gave that to the bank, to the lending institution.
You're still getting taxed on it.
You're still getting taxed on it, and you
Right.
still have to have the cash flow to be able to pay that $3,000,
Okay, yeah.
right? Inside a corporation, that same equation where you're $12,000 in payments, $6,000 in principal.
Yeah.
That $6,000 in principal is now only going to get taxed at 12%. So how much tax does that cost you?
I don't know.
We'll write this down. $720.
Oh, that's like nothing.
Yeah, compared to 3,000,
Yeah.
that's a lot less. And now we've used an example in slightly on the high end of the extreme, in that not all businesses are going to be at
The 50%.
50%.
Yeah.
Maybe you're at 30%, but still 12% still far lower.
Yeah.
And the other thing is a loan with $1,000 a month payments is actually, in today's world, it's a small loan.
That is a low.
So
yeah.
if we've got, businesses that have got $100,000 in loan payments a year,
Yeah.
that's very reasonable. If you borrow $1 million, doesn't take you long to have to pay back $1 million or $2
Yeah.
to be at $10,000 a month.
Yeah.
If in today's low interest rate world, where you're paying half principal and half interest, or maybe even more principal than interest, you could have $50,000, $60,000, $70,000 in principal coming off. And if you're again in the 50% tax bracket, like, how do you pay back $35,000
Yeah.
in tax on top of the $100,000 in loan payments, when you could maybe be paying $7,200?
Makes a lot more sense.
Something more like that.
basically what you're saying is at some point in your business, you're going to get to the point where you're probably going to have larger loans because, you know, your business is growing, you're making more money, you're spending more money. So then at that point, you might want to start thinking about getting incorporated because that's a pretty big tax break on your, on paying back your loans.
It makes a huge difference
Right.
if you're paying back large loans. That principal portion being taxed at the corporate rate rather than at the personal rate frees up a lot of cash flow to help you continue to grow your business. Absolutely.
Okay.